Hello guys, in this session we are going to introduce what is cost, which type of cost we are having in our business, and what is management accounting. Management accounting is the process of identifying, measuring, summarizing, and communicating financial information to internal users. So, who are the audiences of of management accounting? Internal users. Key focuses is on cost is the context of revenue, identification, measurement, allocation, analysis, decision-making, reporting. Cost. What is cost? Cost represents the amount sacrificed to achieve a particular objective, or it's the amount that we are spending and we are sacrificing in order to generate revenue. Cost classification. Cost is the expenditure on goods and services required to carry out the operations of an organization. There are two different costs, direct cost and indirect cost. Direct cost, product cost that can be traced directly to the product or cost unit, like material, direct labor, or direct expenses. Indirect cost, expenses that cannot be traced directly to a product or cost unit, fixed cost. An item of expenditure that remains unchanged in total, irrespective of changes in the level of production or sale. Variable cost, an item of expenditure that in total varies directly with the level of activity achieved. If we increase the level of the production, our variable cost will increase, or if we decrease the level of our production, our variable cost will decrease. For example, this figure shows our variable cost. When volume of activity or the level of the production is increasing, the cost also is increasing. Look at here, just imagine the point here and the point here. Our level of the production, our level of production has been improved, has been increased. So the same, our cost also has increased. So what are the fixed costs? Rent, rates, marketing, audit, admin. Variable cost, materials, packaging, repairs, distribution. Direct one, materials, packaging, indirect rent, rates, admin, etc. So what is break-even analysis? Useful model for the development of pricing and sales strategy. What is it? Based on the assumption that sales will grow and that in the short term, all fixed costs are fixed and all variable costs now as follows. So what is contribution? Each unit sold contributes to meeting fixed and variable costs. So by selling one single product or by providing one service, that amount of money that you are receiving because of your delivering any service or providing any service or selling any product, you are receiving money in return. So that amount of money, it's going to help you, it's going to contribute and cover some part of the fixed cost and variable cost. How we are going to calculate the contribution? It's so important because when we want to calculate break-even point, one element is contribution per unit. So how we are going to calculate total contribution, total revenue minus total variable cost. At the same time, contribution per unit, selling price minus variable cost per unit for one single product. Okay. When we calculate contribution per unit, selling price minus variable cost. So here, selling price 10 minus variable cost 4 pounds per unit. Calculate break-even point, fixed cost divided by contribution per unit, 4 pounds. It becomes 1,750 units. As you can see here, this is break-even point. Okay, now we are going to talk about what is budgetary control and budget variance analysis. What is budget? The budget is an estimation of revenues and expenses over a specific future period of time. It is a process by which financial control is exercised within an organization. It's so important for an organization to have a specific budget at the beginning of each period. It can cover whole or part of the organization. It can be individual operation or multiple stage system. It can cover it can be just based on the cost or cover both costs and revenues. As you can see, this is one of the variance analysis. This is our forecast, or we can say our budget. This is actual or a period. And at the end of the period, this is the variance. For example, we thought our salary would be 90, but the actual one, actually that we have paid as an indirect labor. So we paid 92. So what is the variance? 2. How we are going to calculate variance percentage? Variance divided by budget or forecast 1 multiplied by 100. Budgets are integral to the accounting system. They are attached together. So actual outcome to budget can vary. What we are expecting, what we are forecasting is there's a high percentage, there's high probability that it will be different from the actual data, actual expenses, actual revenues. There are different methods that we can use when we are preparing the budgets. Incremental based budgeting, or is the traditional way that most of the companies and in the past they were using this method. Zero-based budgeting is mostly public sectors and new organizations that are going through it, because they will go from scratch without referring to any historical data, no any model, no previous financial performance, no previous costs or revenues. Activity-based budgeting that mostly is using in manufacturing sector. Traditional one is easy, quick, but is danger of carrying forward inefficiencies from previous years. But zero-based, not incremental, adjusted for variance. Every line item of the budget must be approved, no references to the previous level of expenditure. There are some advantages and disadvantages of zero-based budgeting that you can go through it. Business variance analysis, identify improvements or meet corporate financial objectives. And this is a way that we can measure and control strategic changes. There are 5 ways, like 5 steps that we should take in order to process variance analysis. Identification of key variances between projected and outcome figures, explanation for likely possible causes of variance, projection of these consequences, strategy, which type of strategy we can adopt in order to eliminate or apply some correction for our future performance, for our future budgeting, and critique of budgetary model. Thank you for your attention.